Welcome to this explainer. Look, if you've spent any time in algorithmic trading, you already know the honeymoon phase, right? You build a strategy, the backtest looks like this beautiful 45-degree line straight to the moon, and you confidently allocate your capital. But then, you actually turn it on in the live markets. And suddenly, that perfect upward slope starts looking like a flatlining heart monitor. Well, today we're going to explore exactly why that happens, and more importantly, how professional quantists solve this, using edge decay protection to build portfolios that survive and frankly thrive in live conditions.
Okay, let's dive right into this. This is the ultimate question every single quantitative trader faces when they put real money on the line. Has your live strategy actually stopped being the strategy you backtested? I mean, at what point do you stop blaming normal bad luck and just accept that your statistical edge is completely gone? Because let's be real, there is a massive difference between a healthy strategy going through a standard drawdown and a broken strategy that is literally just bleeding your capital dry.
Our source material today hits us with a pretty painful reality check straight from industry research. It states that strategies that look compelling in a backtest frequently fail to generalize in live markets. Why is that? Well, it usually comes down to overfitting your data, selection bias across hundreds of tested variants, or simply time-varying market conditions, shifting volatility and liquidity. The market changes, but your static backtest, it didn't.
To understand how to really protect your capital, here is our roadmap for today. 1. The backtest reality check. 2. The edge decay framework. 3. Auto-pausing and re-inclusion. 4. Trade portfolios, not strategies. And 5. Real live portfolio results.
All right, kicking things off with Section 1, the backtest reality check.
So, most retail traders use what we can call the old way. They rely on binary, totally emotional decisions, or completely arbitrary rules like, oh, if the strategy drops 15%, I'll just turn it off. But think about it. A 15% drop means something completely different if you've taken 10 trades versus 1,000 trades. The QuantsHaven framework replaces this nonsense with continuous, fractional Kelly scaling and statistical confidence bands. They treat edge decay as a signal detection problem, not just a simple P&L problem. They don't just flip a switch in a panic, they actively scale exposure based on hard math.
Moving on to Section 2, the Edge Decay Framework.
Now, what's really interesting here is this 4-layer funnel. Each layer is specifically designed to separate normal bad luck from true edge decay using the absolute smallest number of live observations possible. Layer 0 establishes an honest baseline. Layer 1 uses z-scores to see if current performance is stepping outside expected ranges. Layer 2 brings in advanced change tests like QuantsHaven and SPRT to catch structural breaks. And finally, Layer 3 makes sure the strategy is actually trading in the market regime it was designed for before sounding any alarms.
Let's zoom in on Layer 0 for a second, because this is absolutely foundational. You literally cannot detect a deviation from a baseline if your baseline is just a fantasy. The framework uses what's called a deflated Sharpe ratio. Basically, it mathematically discounts a backtest based on how many different variants you tried before you finally found the winning one. If you overfit your strategy by testing hundreds of variables, it has no real edge to begin with, and it's going to decay the exact second it goes live. So this layer ensures you're only monitoring robust strategies from day one.
Jumping over to Layer 2, we have QuantsHaven, which stands for Cumulative Sum of Deviations. I actually love this analogy from the source material. Think of QuantsHaven like a bucket. Every single time a live trade underperforms the backtest average, a little bit of water goes into that bucket. If the strategy has a normal winner, the bucket empties. But if the bucket fills up and overflows, boom, it flags a structural change. It's brilliantly designed to catch those slow, persistent, low-grade bleeds in performance long before a simple moving average ever would.
Also in Layer 2 is SPRT, or Wald's Sequential Probability Ratio Test. Now, I know that sounds incredibly complex, but its job is actually pretty straightforward. It finds out if a strategy's edge has been cut in half, and it does so using the absolute fewest live trades mathematically possible. It constantly compares two hypotheses, the edge is intact versus the edge is halved, and crucially, it's totally fine with outputting, hey, not enough data yet, keep trading until it reaches absolute statistical certainty.
All right, Section 3, Auto-pausing and re-inclusion.
So they condense all that heavy math into a single edge health score, which then places the strategy into a tiered action table. If a strategy is green, meaning the z-scores are normal and the math checks out, it trades at its full target size. If it drops to amber, say the z-score drops below -2, the system automatically cuts the trade size by 50%. You're actively de-risking right there. And if SPRT confirms the edge is decayed, it hits red. The system auto-pauses the strategy completely.
But here's the kicker. It continuously monitors it for potential reinclusion if performance stabilizes. No panic, no guessing, just cold, statistical triggers protecting your capital.
So, the crucial point is coming up here in Section 4, trade portfolios, not strategies.
Listen, if you rely on a single strategy, you are incredibly vulnerable. Even the absolute best single strategy will eventually face a regime change, a capacity squeeze, or sudden edge decay. If that happens and your system pauses it, you're just out of the market entirely. This is exactly why we tell people to trade portfolios versus a single strategy. QuantsHaven portfolios are heavily protected by edge decay protection. Because each strategy within the basket is constantly monitored for decay, the system can auto-pause a loser and re-include it later based on its performance, all while your other healthy strategies just keep running. You are protected by continuous de-risking.
Let's move to Section 5 and see how this all builds up. Real live portfolio results. And please note, as we look at this data from the top Sharpe ratio portfolio as of June 2026, these are real live results, not theoretical backtesting.
Check this out. This portfolio generated a real, live total P&L of $317,565. This is the direct live market result of aggregating multiple strategies together and letting that edge decay framework ruthlessly filter out the underperformers in real time. To put that into perspective, that translates to a staggering 63.51% live return on a $500,000 starting balance. Again, this shows what continuous, math-backed edge protection actually delivers. It's not just about finding alpha, It's about aggressively protecting the alpha you've captured by ensuring no single decayed strategy is ever allowed to drag down the whole ship.
And this right here brilliantly illustrates the system in action. Examine the strategies running inside this portfolio. You've got NQ Quant Buy and GC Quant Lutzen showing up as green and completely healthy. But take a closer look at the bottom of that list, GC Quant Zin. It's tagged as caution and it's paused. The framework detected degradation, maybe an overflowing QSIM bucket or a breached Z-score, and it stepped right in. It auto-paused a struggling strategy to protect the overall portfolio's incredible gains while continuously tracking it for potential re-inclusion down the road. The system works exactly as designed.
Now, what I find truly fascinating is the win rate. Across 399 live trades, the win rate is just 52.4%. Literally almost half the trades are losers. This proves that massive portfolio success isn't about finding some mythical strategy that never ever loses. It's about letting your healthy strategies run at full size and using statistical process control to ruthlessly cut or auto-pause the ones that have lost their edge.
So I want to leave you with this question today. After seeing the math, the continuous risk scaling, and the real-time live results, are you still risking your capital on unprotected, single strategies, or are you finally ready to trust the math and step up to a protected portfolio managed by a rigorous edge decay framework?
As always, it's absolutely vital to remember that futures, foreign currency, and options trading contain substantial risk, and honestly, it's not for every investor. Past performance, including the live results we discussed today, is not necessarily indicative of future results. CFTC Rule 4.41 reminds us of the limitations of hypothetical performance, though we have focused heavily on real live market data here today. Basically, never trade with money you can't afford to lose. Thanks so much for joining me on this explainer. Stay focused, trust the data, and I'll see you next time.